Welcome to the Three Edge Week in Review for the week of October 24th. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at Three Edge Asset Management. Thus far in 2022, the world's attention in terms of geopolitics has been focused on Russia's invasion of Ukraine. However, Steve and I will be discussing geopolitics with a focus on China, which recently concluded its Communist Party National Congress, where President Xi Jinping was elected to serve an unprecedented third term. And we'll consider how recent developments in China could impact the global markets from here. First, a brief look at the markets. And although equities have rallied thus far in October, it has been a bumpy ride. This past week, for example, large tech stocks took a beating, with Meta, or the company formerly known as Facebook, falling over 20% on Thursday. And the S&P 500 index is still down around 19% year to date. There was good news on the economic front this past week as the report on gross domestic product for the third quarter was in positive territory after 2 quarters of negative GDP growth. However, GDP report also showed that consumer demand in the U.S. may be softening. Wall Street is still expecting the Fed to raise short-term interest rates by another 75 basis points at the FOMC meeting next Wednesday. In addition, the yield on the 10-year U.S. Treasury is now hovering around, and in some cases lower than the yield on the 3-month Treasury bill. And even though it's not precisely the way we measure the yield curve here at Three Edge, it's still a signal that investors may be anticipating an economic slowdown and even a recession ahead. So, Steve, let's get started. As I mentioned at the top, China has concluded its National Congress. President Xi has clearly consolidated his power over the party and the country. And I know we've talked in the past, and we'll continue to talk about regime shift in the global capital markets. And it certainly seems as though China is moving away from, its particular brand of growth-oriented, business-friendly globalization and towards a much more nationalistic, self-sufficient in terms of their policies. And since what happens in China, the world's second largest economy, will impact the rest of the world, how do you see the situation in China potentially impacting the global capital markets, particularly in the aftermath of this Communist Party National Congress?
Well, Fritz, I think you're right to focus on China right now. There's a lot going on there. But particularly over the last 20 years, China is a much bigger part of the global economy than it was 20 years ago. So what happens in China has a much greater ripple effect throughout the global markets. So I think it's very important. And as you mentioned, the Chinese economy over the last couple of decades has really grown rapidly because of the major shift to free market capitalism. Also, the fact that they joined the World Trade Organization. This has had major effect and benefit to China. And now, based on the recent election, as you mentioned, there's a big swing back. You can call it a regime shift within China that causes a global regime shift, but there's been a big shift back favoring Communist Party ideology, priority for national security, loyalty to the party, control over the people, building up their defense, taking over Taiwan, becoming much more autocratic, versus that beneficial shift 20 years ago to free market capitalism. Also, there's now a big emphasis because of the geopolitical tension with the West on self-reliance and a decoupling and not benefiting from world trade. Just in the last few days, markets took notice, and in China alone, some have estimated that there's been a $6 trillion loss in market value in the Chinese equity markets. It's been a huge drop as people are seeing this regime shift. In addition, there are other problems in China. There's a real estate bubble that's in many ways far worse than the real estate bubble we had in the US that precipitated the great financial crisis of 2008. That bubble in China is bursting. There are COVID lockdowns, worsening demographics. This all points to a growth slowdown in less world trade, which will have a stagflationary effect on the rest of the world, where it'll help bring down global growth and remove one of the props, one of the deflationary props, and help exacerbate inflation.
Excellent. That's a very good overview, although it's a bit dark overview, but yeah, I think the situation there has clearly changed. So let's talk about one specific thing about China, and that's the Chinese currency, the renminbi, which has declined to levels versus the US dollar not seen since 2007. And I mean, some of that weakness, I guess, is a function of the corresponding strength of the US dollar. But it also is a response, I think, to things that you mentioned, like the draconian near zero tolerance for COVID, and maybe going forward now, perhaps nervousness around the possibility of China becoming more autocratic. But anyway, perhaps you could discuss what are the implications for the global capital markets in terms of a weak Chinese currency.
Well, some people might look at the Chinese currency weakening and think, well, why is that relevant? Mm-hmm. And our research has shown over many cycles that whenever the Chinese yuan falls sharply, bad things typically happen, not just in China, but in the equity markets in general. And that's one of the factors we have in the model. Now, if we look at the accompanying chart, you'll see how far the Chinese yuan has fallen recently. And this is not a great leading indicator in general. And often there are negative impacts on global growth because when the Chinese yuan falls sharply, it's an indication that since China is dependent on buying lots of goods and commodities that are typically priced in US dollars, it's a lot harder for them to afford that. So they pull back the demand. And now that they're such a big part of the global economy, that lowers demand for many commodities and other goods that companies produce. And we've already seen the impact on some commodities to that effect. So we look at this as a potential drag on the global economy.
Excellent. So as always, my final question seeks to get to very specific investment implications for what we have discussed here today. And I would note that Chinese equities are down around 40%, I believe, year to date. And according to our model research, they still remain unattractive. So perhaps you could just hit on a little bit more detail in terms of why Chinese equities have suffered so much, and are probably going to include many of the things you already mentioned, but also what would need to happen to change that, to make China and Chinese equities actually become attractive again.
Well, we look at many inputs to the model that would look at the outlook for Chinese equities. And some of those are indirectly from political changes that are happening that we've been discussing. Some of those are economic, where in the past, whenever the Chinese economy slowed down, they'd reach back and create a massive stimulus program. And it would help not only China, but the rest of the world. That's what happened after the great financial crisis of 2008. This time around, China is loaded with so much debt. And because the currency weakening, they're really constrained. They're not able to go back and reach and come up with another big stimulus program. Having said all that, the market, as you mentioned, has fallen so much that a lot of the negativity, you could argue, has been priced in.
Right.
So that's interesting. Now, if I try to think of a positive outlook that would change everything in China, it would be a highly unlikely event that there was a sea change in their political thinking and there was a rapprochement with the West, backing down of tensions to take over Taiwan, re-engaging with global trade. And that would be a huge positive because while there are so many negative factors pushing down Chinese stocks, they've come down so far that by some conventional measures, they're highly undervalued. Having said that, without that rapprochement I discussed, there could continue to be downside forces pushing China in the wrong direction. And you'd have to think if geopolitical tensions get more and more severe and sanctions get bigger, maybe we even have regulations against capital going to China. You have to ask the question, has China become uninvestable? And it's time to ignore basic valuation measures and just stand back and see how things unfold.
Excellent. I mean, that really is what we're seeing here really is a sea change from the last 20 years. So that's very insightful. So thank you. Thanks for shedding light on the current situation in China. It'd be interesting to see how this all develops. So that will do it for Steve and me for this week. And as a reminder, all of our videos are on our 3Edge YouTube channel. And in addition, all our videos and all of our written commentary are always available on our website. And that is at 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.